It's 2026, and maybe you finally decided this is the year you stop putting off investing. You don't want to get rich quick or chase some crypto thing your coworker won't shut up about. You just want to do this right. Build something that actually lasts and not look back in 10 years wishing you'd started sooner. But here's the thing. Everyone keeps talking about dividend ETFs like they're some magic retirement hack. And honestly, it's confusing. Some people swear by funds with 4% yields. Others say those are traps. Some guy on Reddit says one ETF is the only one you'll ever need, and then you check the numbers and it's been losing money lately. So, which one do you actually pick? And more importantly, which ones can you hold for 20 or 30 years without constantly second guessing yourself? Because if you pick wrong, you could spend decades putting money into something that barely keeps up with inflation. And by the time you realize it, you've lost years you can't get back. My name is Richard, and I teach the money stuff schools should have taught us, but didn't. I spend a lot of time figuring out why some regular people slowly build wealth without freaking out, while other people work just as hard but never seem to get ahead. Make sure you smash that like button and hit subscribe if this video helps you think about money a little differently. Now, before we jump in, let me ask you something real quick. Have you ever opened up an investing app, looked at all the choices, and just completely froze? Like, you see 100 different fund names with letters like SCHD and VIG. Some say they'll pay you 1.6% per year. Some say 3.8%. And they all have these fancy names that sound super important, but you have no idea what any of it actually means. And then you go to Google and type Best Dividend Fund 2026, hoping for a clear answer, and instead you get 10 different websites all saying different things. One article says, definitely buy SCHD. Another one says, no, VIG is way better. And the whole time you're sitting there thinking, what if I pick the wrong one? What if I spend the next 5 or 10 years putting my money into something that's barely growing? What if there's some button I'm supposed to click that I don't even know about? That stress, that feeling of, I really don't want to screw this up. That's exactly why I made this video, because this stuff actually matters. If you pick a fund by looking at the wrong number, you could spend the next 30 years with way less money than you should have had. And the scary part? You might not even realize you made a mistake until it's way too late. But here's where it gets really interesting. Most people pick their dividend funds by looking at just one number, how much it pays you each year. They see one fund paying 3.8% and another paying 1.6%. And they think obviously the 3.8% one is better, right? And you know what? For the first year, they're actually right. But I'm about to show you why that thinking completely backfires when you're planning to hold on to these funds for 20 or 30 years. Because if you don't understand what you're actually buying, nothing else I say in this video is going to help you. Most people skip right over this part. They just want someone to tell them buy this one without understanding what it actually is. And that's how people end up stuck with the wrong investment for years. So let's clear this up right now. A dividend ETF is basically a big shopping bag full of different companies that send you cash payments on a regular schedule, all wrapped up into one simple investment you can buy. Instead of you having to research and buy 50 different stocks one by one, you just buy this one fund and boom, you instantly own tiny pieces of all 50 companies. It's like going to the store and buying a pre-made fruit basket instead of walking around picking out every single apple and orange yourself. Someone else already did all the hard work for you. You get a bunch of different companies without doing any research. You get cash payments without having to sell anything. And you don't have to worry about picking bad companies. That's why people love these. They're simple. You don't have to babysit them. And if you pick a good one, it can just sit there growing your money in the background while you're at work or hanging out with your family. Here's the part where it gets really important. There are two totally different types of these dividend funds, and most beginners have no clue they work completely differently. Type 1, high-paying funds. These give you bigger cash payments right now. More money in your pocket today. And then there's type 2, growing payment funds. These start with smaller payments, but those payments get bigger and bigger over time. And here's the part that trips everyone up. Think about it like choosing between two job offers. Would you rather have a job that pays you $50,000 a year, but you never, ever get a raise? Or would you take a job that starts at $30,000, but gives you a 10% raise every single year? In the first year, obviously the $50,000 job pays more. That's just math. But here's what happens. By year 10, that second job is now paying you way more than 50,000, and it keeps going up and up. And by year 20, it's not even close anymore. That's exactly the difference between picking a fund because it pays you more today versus picking one because the payments grow every year. And most beginners don't figure this out until way too late. They pick the fund paying them 4% right now. They feel great about it in year one. And then 10 years down the road, they're scratching their heads wondering why their friend who bought the boring 1.6% fund somehow has way more money than they do. Here's what nobody tells you when you're just getting started. The fund that pays you the most money today is almost never the one that pays you the most money 20 years from now. The whole thing flips upside down when those payments start growing year after year. I didn't believe this when I first started learning about this stuff. I thought, just pick whichever one pays the most right now. But then I actually sat down with a calculator and ran the numbers over 10 years, 20 years, 30 years. And I was honestly shocked at how much more money the slow and steady growing funds ended up giving you. So why am I telling you this? Because if you're 25 or 35 years old right now, and you pick your fund based only on which one pays me the most this year, you could be walking away from hundreds of thousands of dollars over your life. Maybe even more, and I'm not exaggerating to sound dramatic. That's literally just how the math works when money grows over time. Then, what should you actually be looking at? Let me show you using 4 real funds and a real guy's story. Let's call this guy Jerry. He started with $50,000 back in 2017. He was 35 years old, working a regular job, and he just wanted to build something for when he retires one day. He didn't try to guess when the market would go up or down. He didn't try to pick the perfect individual stocks. He just took 4 popular dividend funds that everyone was talking about back then and split his money evenly between them. $12,500 into each one. Then he clicked the button that says automatically reinvest, which basically means every time the fund sent him cash, it would use that cash to buy him more shares automatically. And then he just left it alone for 8 whole years. He didn't sell when things looked bad. He didn't panic. He didn't mess with it at all. And what happened? It surprised even him. Let me walk you through each one. VYM is like the ultimate play it safe option. It owns over 500 different companies that pay dividends. We're talking every type of business you can imagine. Banks, oil companies, hospitals, tech companies, the people who make your toothpaste, literally everything. Right now it pays you about 2.5% per year. And the fee to own it? About 0.06%, which is basically like paying 6 cents for every $100 you invest. Almost free. And it's been increasing those payments for 14 years in a row. Sounds pretty good, right? Jerry liked it because he thought, I'm not trying to guess which companies will win. I'm just owning a little piece of everything. But here's what he didn't realize. When you own that many companies, the really fast growing ones get mixed in with a bunch of slow, boring ones. So over the last 5 years, VYM's payments only grew about 4% per year. And that's actually slower than the price of groceries and rent going up. So yeah, it's safe. It's not going to blow up on you, but it's also not super exciting. Jerry's $12,500 grew to about $25,000 by 2025. He doubled his money, which is nice. And now it pays him about $632 a year. That's solid, but it's not enough to change your life or anything. And honestly, Jerry started thinking, what if I'd picked something a little more focused instead of spreading myself so thin? Now, FDVV is where things get really interesting. It's still a dividend fund, but this one leans way more toward companies that are actually growing fast. It owns about 120 companies, and a bunch of them are big tech names. We're talking NVIDIA, Microsoft, Apple, Broadcom, companies you don't normally think of when someone says dividend stock. Right now, it pays about 3.1% per year. The fee is a tiny bit higher at 0.29%, but that's still super cheap. And here's the number that made Jerry's jaw drop. Last year, FDVV's payment grew 22% in just 1 year. Remember, VYM was growing at 4% per year, and FDVV just cranked out 22% growth in a single year. So Jerry's $12,500 in FDVV turned into almost $30,000. And now it pays him about $926 a year. That's nearly 50% more cash than VYM is paying him, even though he put the exact same amount of money into both. But there's a catch you need to know about. FDVV is only 8 years old. So we don't know how it handles a really bad market crash yet. And because it's so heavy in tech stocks, that means when tech is doing great, this fund does amazing. But when tech gets scary, this fund could get scary too. But Jerry's not selling it because that payment growth is exactly what he's trying to build. He realized something huge. If his real goal is to have a lot of income 20 or 30 years from now, not a lot of income right this second, then having his payments grow super fast matters way more than getting a slightly bigger check today. SCHD is the one everyone on Reddit won't stop talking about, and honestly, for good reason. It's a really solid dividend fund that's been increasing its payments for 13 years straight, and it focuses on what people call value stocks. Basically just boring, reliable companies that actually make money, aren't drowning in debt, and send out consistent cash payments. Right now, it pays 3.8% per year. That's the highest payment of all 4 funds we're looking at. The fee is super cheap at 0.06%, and it owns about 100 companies. The top companies in it? Boring stuff like AbbVie, Chevron, Coca-Cola, the kind of companies your grandparents have heard of and probably own stock in. But here's where it gets really frustrating. Over the last year, SCHD is actually down about 2.5%. Meanwhile, the overall stock market is up over 17%. Ouch! Jerry's $12,500 in SCHD grew to only about $22,000, the slowest growth of all 4 funds he bought. It does pay him about $851 a year, though, and for a while, Jerry was really annoyed, and he kept reading all these articles saying SCHD is the best, but his was the only one losing money. But then something clicked for him. SCHD isn't broken. It's just not the cool kid right now. Tech stocks are winning. Fast-growing companies are crushing it. And the boring, reliable companies SCHD owns? Nobody cares about them at the moment. But then Jerry remembered what happened in 2022. When the overall stock market crashed and dropped 18%, SCHD didn't fall nearly as hard. While all those flashy tech stocks were getting destroyed, his SCHD just kept sending him cash payments every 3 months, like nothing was even happening. So he's not selling it. He's keeping it. And honestly, he's actually buying more of it right now while it's down. Because here's what smart investors know. The best time to buy really good quality stuff is when nobody else wants it and the price is low. VIG is the one Jerry almost didn't buy at all. It only pays 1.6% per year. That's less than half what SCHD pays. He looked at it and thought, why on earth would I take 1.6% when I can get 3.8% over there? And dude, does he regret thinking that way now? Let's talk about the fee. Only 0.05%, the cheapest of all 4. It owns about 340 companies. But here's the thing. Every single company in this fund has increased its payment for at least 10 years in a row. That's the rule to get in. You have to have raised your payment every year for a decade. No exceptions. Now here's where it gets crazy. Even though VIG pays way less than SCHD right now, it actually made Jerry more money overall. His $12,500 in VIG grew to about $23,000. Sure, it only pays him $379 a year right now, the smallest payment of all 4 funds. But wait, look at what actually happened over time. VG grew his money better than SCHD did, and VIG's payments grew faster than VYM's, even though VYM pays more today. See, VIG isn't trying to give you the biggest check right now. It's looking for companies that keep increasing their payments year after year after year. We're talking about Microsoft, Apple, Broadcom, JP Morgan, really strong companies that keep making more money and keep sharing more of it with investors. And when you hold on to that for decades, it absolutely destroys the competition. Jerry wishes he'd put 40% of his money into VIG instead of just 25%. Because think about it. When he was 35 years old and just starting, he didn't need a big payment right away. He had a job paying him. What he really needed was for his investments to grow like crazy. and for those payments to get bigger and bigger over time. And that's exactly what VIG did for him. Most people who are just starting out look at 1.6% and think that's garbage. But Jerry learned the hard way. Getting a small payment today doesn't mean you'll be poor tomorrow. What really matters when you're holding something for 20 or 30 years is how much your total money grows, plus how fast those payments increase. And here's the part that absolutely blew my mind when I was digging into all this research. If you actually sit down and do the math on a fund paying 1.6% that increases that payment by 10% every year, versus a fund paying 3.8% that only increases by 4% every year, by year 15, the one that started lower is actually paying you more money per year. And by year 25, it's not even a fair comparison anymore. That's what people mean when they talk about compound growth, and you can't see it happening in year one. It's completely invisible at first. Okay, so we've looked at 4 really solid funds: VYM, FDVV, SCHD, VIG. But here's the million-dollar question. Which one is actually right for you? And the answer totally depends on one simple thing: how old you are. If you're in your 20s, 30s, or even early 40s, you don't need to worry about getting big payments right now. You've got a job that pays you. You've got literally decades ahead of you before you retire. What you actually need is for your money to grow like crazy. You want those payments to get bigger and bigger every year so that 20 or 30 years from now, you're getting massive checks. This is when you should put most of your money into funds like VIG and FDVV. Maybe something like 40% into VIG, 35% into FDVV, and 25% into SCHD. Sure, you're getting smaller payments today, but those payments are going to grow way faster. Here's why this works. When you're young, time is literally your secret weapon. You don't need a bunch of cash today. What you need is for your money to grow as fast as humanly possible. And when those payments keep growing year after year, it works exactly like your account value growing. You can't really see it happening at first, but over 20 or 30 years, always it becomes absolutely massive. And once you hit your 40s and 50s, things start to change. You still want your money to grow, but now you also need to play it a little safer. You're getting closer to the day when you'll stop working, so you can't take as many chances with big risks. This is when you start adding more SCHD and maybe some VYM to the mix. Something like 35% SCHD, 30% VIG, 20% FDVV, 15% VYM. You're basically shifting from grow as fast as possible to grow pretty well, but also protect what I've already built, because you're moving from I want this to explode to I want this to keep growing, but I can't afford for it to crash right before I retire. You still want your payments to keep increasing, but you also want stuff that won't freak you out if the stock market has a bad year. Think of it like one of those sliding scales. On the left side, you're young. You want mostly growth stuff, VIG and FDVV. On the right side, you're near retirement. You want mostly income stuff, SCHD and VWM. And as you get older year by year, you just slowly slide from the left side to the right side. That's literally it. Here's what most beginner videos get totally wrong. They tell you to just pick whichever one pays the most, no matter how old you are. Just buy the one paying 4% and you'll retire early. But think about this. If you're 28 years old right now, and you won't retire for another 35 years, buying a fund that pays 4% today but only grows those payments by 3% per year is actually way worse than buying a fund that only pays 4%, 1.8% today, but grows those payments by 10% every year. If you run the actual math, it's not even close, but nobody ever explains that part to beginners. They just show you which one has the bigger number today and assume that's the whole story. DRIP stands for Dividend Reinvestment Plan. Basically, it means every time one of these funds sends you cash, that cash automatically buys you more shares of the fund. You literally don't have to lift a finger. It just does it for you. And this part is absolutely critical. Harry's payments grew by 250% over 8 years, specifically because he reinvested every single payment he got. If you just take that cash out and spend it, you're literally throwing away free money. You're stopping all that compound growth before it even gets a chance to work. The good news? Most investing apps have a simple button you just click once. It usually says something like reinvest dividends. You turn it on one time and then forget it even exists. Let's say you're 30 years old. You make $60,000 a year at your job, and you can afford to invest 500 bucks every month. Here's a dead simple way to start. Put $200 into VIG. Put $200 into FDVV. Put $100 into SCHD. Then set up automatic investing so it happens every month without you thinking about it. Turn on that dividend reinvestment button, and then check it once a year just to make sure everything looks normal. That's literally it. I know it sounds boring, and it is. But boring actually works. You don't need to watch CNBC. You don't need to read the financial news every morning. You just keep putting money in every month and let time do all the heavy lifting for you.